So the same we have with us Upasana Chachra, Chief India Economist from Morgan Stanley. Upasana, thank you so much for giving your time to ET Now. To start with, IIP for the month of July came at 3.5%, which is highest in the last 4 months. What could have led this? Can this momentum be sustained in the coming months as well?
Hi, thank you. So I think what we are seeing is some sort of some recovery in high frequency indicators. That is true for, the data if you see from the beginning of this year. At IIP, if you were to see, the numbers have been a bit lackluster over the last few months, but yes, July does show some sort of an upturn. I would suspect that, we'll see these numbers in this range for some time because we do have the uncertainty from the external side, and especially post August, I think is when we'll see the impact of the higher tariffs and what that means on the export growth. Because up until August, we should keep in mind that there has been some amount of front loading of exports, and that could have impacted the July IIP numbers as well, on a positive way. And post August is when we'll see how exports and therefore its repercussions on the IIP numbers turns out to be. But having said that, I think macros for India remain pretty solid. We will have the quarter ending June data released later today, and I think we'll be looking at a number which will be upwards of 6.5% on the GDP.
All right, hi Upasana. Morning. This is Shrishti also joining in. But with CPI inflation easing to like 1.6% and the recent industrial growth figures, they are also looking good. Do you see the scope for India's GDP estimate to be revised upwards?
I think at the moment the balance of risks for growth is pretty evenly balanced because of the risks that we see from the external drag, i.e. because of the higher tariffs if they were to sustain for longer. But at the same time, there's likely to be an offset from the fiscal response, and we'll get more details in terms of what is the GST rationalization and the tax cuts that we see on that side and its boost on growth. And therefore, I think the domestic demand response that can come through because of both the policy easing on the monetary side and likely boost from the fiscal side will offset the drag from external demand. So at the moment, I think the risks are balanced. We can be cautiously optimistic for the second half, but yes, we'll have to wait for more details on the fiscal side and then see what type of multiplier and what is the final impact on growth. On inflation, yes, I think the story is pretty well known. Very benign trends in the recent data points that we've seen. That is led by lower food inflation, but even on the non-food or core side, inflation numbers are well behaved, and we expect the same. So on that side, that continues to support that potentially there can be some more monetary policy easing as well.
Absolutely. Upasana, since you did touch base GST rate rationalization, now how do you see the rate rationalization impacting both inflation and demand? And also, do you expect the RBI to revise its 4% inflation target?
So on the GST side basis, what we know from news flow is that the impact or the size of the stimulus could be somewhere around 0.5% of GDP on an annualized basis. When you look at the tax multipliers, because GST is an indirect tax and it's largely regressive in nature, and therefore the tax multipliers are higher. So i.e. as tax rates on these items are lowered, they benefit all income classes and especially the low income households. So with a multiplier which is above 1, let's say 1.1, the impact on growth on an annualized basis can be upwards of 50 basis points. Of course, we need to see what is the final size of the stimulus, but the impact on growth on the positive side could be somewhere between 50 to 70 basis points. On the inflation side, GST can act as a sweetener on the inflation side as well, because non-food and even some items of food category will see lower GST rates. And when we see the impact on inflation on a headline CPI basis, we think that inflation could be lower by again 40 to 50 basis points on a 12-month annualized basis. So those are, the pretty sweet impact of GST that we can get both on inflation and on growth. To your question on whether RBI should revise the 4% target, I think that's in context of the upcoming review of the flexible inflation targeting framework. I would say think that they should maintain status quo, because both the flexible inflation targeting framework and the target at 4% with headline targeting CPI headline inflation at 4% has been held, has held the economy in good stead. We have seen that actual inflation, since inflation targeting framework was adopted, has been moving down, averaging less than 5% versus above 6.5% in the previous 5 to 7 years. And also inflation expectations have been trending down. So I think on the whole, the framework has kept the economy and managed the risks pretty well. And I would think that they should maintain status quo.
But Upasana, the other number that we have been tracking is actually India's overall GDP. But along with that, India's overall debt number, that has also recently reached a 3-year high of 158% of GDP. If you can give us some sense, what does this increase signify for the nation's economic stability, and how confidently can we say that India's overall debt burden will remain sustainable?
So on the debt side, I think, when you look at India with comparison of other economies, the overall debt or indebtedness at, yes, above 150% of GDP, it looks high, but on a relative basis, the numbers are pretty, on the lower end when you look at other economies, be it developed or certain developing economies as well. Bulk of this debt is held in the public sector, and that is because of post-pandemic, we did see a build-up of public sector leverage. So public sector debt is around 79-78% of GDP, and the rest is on the private sector side. Overall indebtedness levels are pretty manageable. We would expect a modest expansion because, as domestic demand picks up, that should help sustain some amount of investment trends from the private sector side, which would be leverage induced. And therefore, we do expect that public sector leverage comes down, but private sector leverage goes up, which will keep overall debt in slightly expansionary mode, but it is in context of GDP growth that we should see, and therefore on a GDP growth basis, there are no debt sustainability issues, i.e. GDP will continue to grow on a real basis at say 6.5% in the medium term, and that will ensure that the public or the private sector doesn't see any debt sustainability issues. Rather, macro balance sheets remain pretty much in good shape right now and in the future as well.
Right. Upasana, considering all that is happening on the global front, and at the same time looking at the domestic front and the economic indicative action, the data, the statistics, it all looks quite promising. But what, according to you, are the most significant risks that could undermine India's current outlook on debt and growth trajectory?
So on the risk side, I think from the near term, the external side does pose risks. We do have the uncertainty now. Probably we have, some amount of certainty that tariff rates are higher and they're here to stay. But there is still, uncertainty in terms of how those levels may pan out in the near term. Second is the impact on from global growth, because global growth is likely to see a moderation as per our global team's view, given all this uncertainty that stems from the US trade and tariff policies. But any further downside on global growth will have repercussions on India's growth cycle as well. And I think, again, geopolitics from the global side can pose risks in terms of how it impacts not only growth, but also, say, commodity prices, capital flows, risk aversion, etc. On the domestic side, I think the risk factors are fewer at the moment because macros are in control. There is likelihood of policy response actually from the fiscal side, and we already have seen monetary policy easing and maybe potentially some more to come, which will support growth. And there's no as such, actually build up of debt or leverage in any pockets, which is creating concerns or issues in the near term. So as such, I think the risks from domestic side are fewer. I think risks are mainly from the external side, which we need to be watchful for.
All right, but Upasana, with this, I would like to thank you for taking the time out and speaking with us this particular morning. Really appreciate that.
Thank you.
But for this, viewers, it's time now to slip into a very short break. Yet again, don't go anywhere. Lots more to talk about on the other side.